This is a brief recording, and I'm going to show you a simple application of the fair value gap usage. This is volatility tennis, and I am in my 30-minute time frame right now. So navigating to this position, you can see price trading below all of these lows here and violating a structure here. This is a low being taken out, price violates the low. When we see a setup like this is how we trade it. We violate a point that looks like a support. Now the algorithm is going to come back into the range to look for something to reprice with, and then trade to violate all of the stop losses below these lows, and we have another low here. Now I'm going to navigate to a lower time frame to show you the price structure there, and you can use this to anticipate your trades next time you see a setup that looks like this. So this is the fair value gap being marked out already. It's candle number one, candle number 1, candle number 2, candle number 3, the disconnection in between here just above the support zone, and this is a zone we anticipate price to maybe reach out and then continue to take out the support cleanly. So this is actually a low form of resistance run. That means there will be no much opposition against this trade because it's a trade running against support. Now I'm going to navigate to a smaller time frame for you to see the element that triggers this trade. Yeah, so this is the range of the fair value gap from here to here, and you know how our entry trigger for fair value gap usage is. But now this is not a fair value gap in premium because we want to sell, so we normally look for positions in premium, but this one is not occurring in premium. Now how do we use such fair value gaps? You navigate to lower time frame. I'll go to 1 minute. Now this is 1 minute of the fair value gap, and this is the point where price did penetrate into the fair value gap range. And what do you see here? Trading to a reference point, and then we'll break down like this. Then we have a break of structure here. So we have this low being taken out and drive from here to here. See price trade back into the premium zone in a lower time frame now. Swing high to swing low, and you see price trading back to equilibrium into deep discount range and then releasing itself to the downside. Now once you get into this position, your stop loss is going to be above this major swing high, this one here. Price, after giving you your entry, trading back into premium, you see price running to take out all of these lows, run back up to take out these highs, but not violating your stop loss, releasing itself to the downside and continuing until it take out the major low here. So this is a very simple application of the fair value gap. Go on into your chart and see if you can see similar examples to this, and see how you take note of all of the processes and how I navigated from the different time frames and why I did navigate from the different time frames because of where I spotted the fair value gap.